finance is probably the oxygen or water or whatever you want to call in this field. I see banks' role as two parts in real estate. There is the B2B and there is the B2C part.
NBFCs money does not come from fixed deposits, right? They don't accumulate money from the market, public market, which means they are not liable to give 7.5% as return. Dhoni, the picture boy for a developer, all those things we saw as a kid. Very few cases, developer owns the project on day. When the land bank is not available for almost 95% of the developers, nobody can own the land.
The bank is the only person who benefits from delays.
Welcome to Reality.Club podcast episode number 15. Today we are going to discuss about, we have been discussing about the developers, we have been discussing about the agents. Now we have another key stakeholder about whom we never spoke about it. And today we are going to talk in depth, or we are going to start talking about them in depth. We're going to talk about the bankers, and joining me today, as usual, is Badri from Chicago and Arun C.R. right in the next cabin of our office right here. So hello, and let's begin. Badri, it's you who gave a hint that we need to go deeper into the important lifeline of the real estate space. That's the people who finance it. And bankers are one of the key stakeholders about it. And how we'd like to structure this conversation forward, and what is that you'd like to take things about?
Definitely. So first, a little brief about my understanding of the situation. I think there is obviously a misconception amongst the public, the consumers, maybe even sections of the trade that builders are like rife with cash, and like real estate is a profession where like people with 1000x kind of come and play with 10x or 5x. Whenever it comes to every project, they always think the builder is like probably the builder's net worth, or builder sitting with like 1000 times cash of like each project. So it is just like cash is not a big constraint, at least for large builders. This is a very wrong misconception. Finance is probably the single most lifeline or oxygen or water or whatever you want to call in this field, right? Whether it is small builders, mid builders, or even large builders, the way they handle cash finance right from the beginning to kind of through the life cycle till the handover is key. Like it's make or break. Probably if you can put top two kind of factors in real estate, one is finance and liquidity management. The other is obviously execution skills when it comes to building. These two are probably the two top things for any sustainable developer, right? So Arun, first I want to have a rain check with you. Am I right when I say these two? Then we'll go to like what I want to talk about bankers.
Yeah, definitely. I think that's a brilliant way to put it forward. Is that people? This is the most market driven in terms of finance. I mean, no promoter holds or can hold beyond 20-30% from his pocket on any project, right? If he is actually having certain ownership or direct stake beyond 30, 40, 50%, that's where probably the developer starts to develop some sort of an emotion over the project and get hooked to the project. And it's I would say from being a marketer, the guy who assists in marketing, see this, whenever there is the developer who has invested or bought property, I mean land on his own, and if the land constitute almost closer to 50%, right, of the entire MRP, then invariably I see the switch in terms of decisions, delay in terms of weight, and the weight in terms of price hike. All of these things creep in. When there is, at the same time, on the other I would say, end of the poll, if you see, there are builders who have less than 15% stake, invariably go havoc, right? In terms of financial mismanagement and things like that. So those people who do anything between say 20 to 30%, say around 25% share for themselves, are the one who will be very fast and efficient in terms of execution. They would probably try to always deliver on time, deliver on piece. I mean, I do not know whether I'm making sense here,
Yeah, yeah,
but
yeah.
you guys are getting me. So
It's a
that,
very
that's
it's a very gold standard number. I don't know if this is the case in India. In the US, if you, even as a personal investor, like a lot of people buy property as an investment. A lot of people are kind of full time into flipping real estate, like buying stuff and then making it over and flipping. But whenever it is your second property or beyond, even as an individual investor, typically the commitment is like, if it's the first property, even 5% down is good enough. But if from the second property onwards, 20% definitely you have to kind of put down. That's the rule here, right? The bank would only finance 80% compulsorily, right? So that kind of becomes a gold standard. The 75, 85%, 80% of like kind of borrowed money, borrowed capital, 20, 25% of that kind of is the right balance of your skin in the game, but then you are not kind of overindulging and kind of burning your capital.
absolutely. That's a right way to put it. I mean, be it a retail person or an investor or an end retail market, consumer, or the guy who's actually development, invariably that percentage remains same. In respect to heroes or the value of the project which goes up, even if the project is like 1 lakh crore, right? Uh, that's where dynamics works. So even I would say this also is a very good point in terms of product planning, right? Say let the value of land could be of any nature. I do not know how. I mean, coming back to bringing the context of bank as well, right? Banks, how do they even judge these projects? Is a point of. I mean, how do they evaluate, right? Because they are sitting with depositors cash, and then they have to basically make percentages over and above the FD rate what they give. um, so which means today's FD rates are at about 7.5%, 7.5%, which means they can, at best, they have to make it 9%, right? They have to charge 9% on that cash. Why, if I'm doing I mean, if I'm lending only for say 2% margin as a banker, then my risk has to be less, and it has to be relatively better, right?
Just to take a one quick pause and then I'll come back to you. Just to summarize on Balaji's question, because he probably asked it 7 minutes ago, so I want to summarize. So we have about 25 minutes more. I want to keep it very simple, very structured. I see banks' role as two parts. There is the, in real estate, in any new project, there is the B2B and there is the B2C part. Right? I want to spend half of our rest of our time on B2B and preferably about half of the time on B2C. Right? So B2B is right from day zero, when builder does Bhumi Puja, or even before that, whatever is their touch point of notifying, informing, courting bankers, right? Maybe they also do some amount of prospecting as to like, I mean, different builders have different situations, right? Some go behind build banks, some are so good that banks go behind them. Whatever it is fine, right? So I want to start one, dedicate some half of it to the B2B side, which is financing the project right from the beginning till stage by stage. What are the considerations and stuff. The second part of it is obviously the B2C, which is more like how do they engage with buyers, right, on financing it step by step till possession. So I want to do B2B and B2C. So you can start with B2B, Arun, because obviously you are exposed to both, but you can start with B2B.
Okay. So just to define B2B and B2C, I'm just trying to again probably rephrase it from the context. Probably I'm setting the context and then getting to B2B. Just couple of minutes max, a minute max. Yes. See, as you said, retail or B2C is where the bank lends for a particular house, like individually every house is funded. Even there, what we spoke was 80-20 for a second level home, and maximum they go up to 90% for wild conditions, like the less affordable segment of sections. They go so typically 75% to probably 85% is the right bracket to consider for a bank to even lend here, and there also it's almost the same, right? So across the globe, how bank works is like this: they get money from the public, where they are paying interest. Whatever they are paying interest for, the percentage, that bare minimum they add up a certain margin for the bank operation and give it as debt for the home loans. It's just not for home loans; it is for any other car, bikes, and things like that. Why home loan? But in spite of all of these retail, home loan invariably is the largest consume. I mean, the value in terms of good which they could fund, which means probably 3-4 cars can only put together a home, right? So, or even some other bikes and all is much bigger, and so it's easy. So that's why banks tend to move align towards a home. That is one. And second, as an asset, gold and home are the ones which will not depreciate for them, right? As an asset, they have wants to basically liquidate. At least they have an option. Vis-a-vis a car or a bike, the bank tends to do it. So why am I giving this bank's perspective before getting into B2B, and also B2C perspective is to understand B2B better. Okay, so bank is basically looking at this, right? Mitigate risk and get maximum margin from their FD rates, right? This is their objective. At the same time, B2C is where ultimately they get the lowest margin, right? So B2C is where they get about 2%, and that too they have to lend for a long term, right? But long term is where they get they compensate. They get the lowest margin of 2%, but they take a commitment for 20 years, 25 years. Thereby, they make a good double of the money and things like that over a period of. So that how. So this is how the bank starts the market, right? So as a banker, if they start accumulating their market share of, hey, I'm having say 1,000 crores in my bank account, and then now I have to lend to 1,000 crores. Their best way to do is to acquire as many units to de-risk themselves uh, towards the 1,000 homes. Okay. So now it is not just one banker who's available or competing in the market for the end consumers, right? So there are at least the competition dynamics between the banks come in. There are private banks who are there. There are nationalized banks who are there, right? Public banks are there. Private banks are there. So both banks, they compete for same rate of interest, almost plus minus.
Even NBFC, yeah, there are small deviations to the rule. There is private, public, scheduled is almost private, and then cooperative is almost private, and then there is NBFCs also. Yeah.
Yeah. So NBFCs and all those things we have to hold a bit, because they don't typically start or would like to make money from their end consumers. I'll tell you why. Because NBFCs money does not come from fixed deposits.
Okay.
Right? They don't accumulate money from the market, public market, which means they are not liable to give 7.5% as return.
Okay.
They are source of, they accumulate pool of funds from the HNIs, right? From the family offices. So that, I mean, basic. So what happens? Why would they put in money for what interest rate? They need better interest rates than FD.
Yeah.
So instead of me as a investor putting it in FD, I'm coming to another NBFC, which means whatever who would probably want to make a minimum of 9-10%.
Yeah. So if FD is about 10%, as a HNI, I put 12. I want 12% out of the NBFC from my seed capital, and then the NBFC will obviously probably charge 13 or 14% from the
Absolutely. And that's why, if you see, NBFC's operation and bank's operation is almost the same. The margins are same. The point is that the source of money is completely different.
But why is it?
right?
What is there in it for the end consumer to pay more interest? Are these cases where they wouldn't get loans
End,
from somewhere else or something?
yeah, yeah. End consumer normally they don't go to NBFCs, nor NBFCs target end consumers. That's why I said NBFC may not come for B2C,
Okay. Yeah.
even though they may open and
Non-deposit, let's call it non-deposit collecting NBFCs. Probably there are NBFCs which some form collect deposit.
you're right, absolutely. I don't think no non-banking financial institution have the capacity to officially collect deposit is something
Yeah,
which I
the
do not.
non-banking. The word is there in non-banking. Yeah,
Like,
banking is
normally,
this. Yeah,
my level of knowledge, that is not possible.
true, true, true.
So that is a different layer. So what we need to understand is these are the source of money which they could collect. So bank probably would be sitting with a lakh a crore as fund pooled from retail investors. Vis-a-vis an NBFC would be sitting on a pooled fund of say 5,000 crores or a 10,000, 15,000 crores, right? So the pool of money of the fund size itself is different. Now, with this pool of money, the NBFCs would more likely to compete with the bank at the B2B level rather at a retail level, because with that money and with that operational, with no branches, not many branches or not many cities to operate, NBFCs cannot compete at a retail level, like the real retail level at every city at this level. Vis-a-vis, the bank comes up with the base customer base of bank accounts, FD bases, salary accounts, XYZ. With that, they are going to attack the retail, right? So, and NBFCs cannot play long term, right? They are not going to sit here and wait for 25 years to make returns, right? So all these things are against the NBFCs or against the guys who pull from the people, where maximum tenure can always be. I mean, the pool or returns have to be a 7 to 10 year cycle, right, for investors. So typically, so that's where. So unless these guys make money in 5 years time, they won't be able to commit something for 7 years to the investors. So that is also one of the point where NBFCs go towards a B2B. Okay, so this is the financial or money available for, or a capitalization or debt available from various sources for the B2, in the market. So bank's objective is ultimately to move towards B2C. Before moving B2C, how do I even take additional leverage by funding the project is what bank's intention is. Okay, can I go on to even take an additional leverage of funding the entire project for construction? Thereby, I make that 2-3 years ka margin, which is not the great thing, but I have control over some customer base, or probably can I take a market share of the customer base of the project? This might be the primary objective. Okay, it's more a strategical approach the bank comes from. But NBFCs, on the other hand, comes very straightforward. They need returns from the project. If
Also,
NBFC
also
are
if it,
private,
also if and when if it is immediately or in a few minutes you're going to spend more on B2B, I also want you to talk a little bit more about B2B landscape is a little more complicated. There are infrastructure finance corporations, there are housing development corporations, there is LIC, there are just in you may broadly call them NBFC or they are probably beyond that, but there are a lot of complicated actors in B2B which a lot of laymen don't understand. But yeah, essentially it's a funding entity.
yeah. So yeah, you mixed a lot of names. I would say, see, LIC again can have a long-term play, which means
Okay.
they have insurance money with them, which could be leveraged or return could be achieved
Yeah.
over
Sure.
more than 10 years after, right?
Okay. Okay.
So that's why they actually come to retail. They
Okay.
compete with retail, even though they are not a bank,
Okay.
right? So there is a LIC HFL, which is housing finance loans, which is very popular or competing there, right? And then comes Sriram. Sometimes they do. Godrej sometimes they do. How they do is something which I will let me come back to you,
Okay.
right? So that is a different layer. But let's stick to the banking system, right? Banking system or the finance credit.
Sure. Sure.
So
Yeah.
the point what you need to understand from any of this fund or the banks or person who's giving commitment is that where is the source of money which is coming to them, and what is the cycle for them to go, give the churn back the principal.
True, 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 true.
That determines whether they are going to operate in the consumer market or only B2B, right?
Yeah.
So this is the perspective of it.
So let's
And
clarify. B2B here clearly means, because there are always deviations and complications, but B2B here clearly means funding the builder's work, right from like building and delivering the, yeah,
so it's more I would say project funding, right?
project
Product
financing, builder financing, development financing.
development.
Yeah, 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 yeah. Go
It's
on.
called project development fund, right? For now.
Yes, yes, yes.
Right? So this, let's assume this is the objective of the B2B landscape, where a project is conceptualized by a developer, right? I'm carefully using these words called it's conceptualized by the developer. It's not owned by the developer, right? Very few cases developer owns the project on day one, right? Which means the land is on him, right? When the land bank is not available for almost 95% of the developers, nobody can own the land. What they do to even procure land, they have to be dependent on external funding. External. So now in external financing, when the developer is going out, there are all these funds are available in front of them, right? So who comes where at what is cost for the developer, right? So now the developer wants fund, he is looking at the cheapest fund possible, or if nobody is available to fund at that point in time, he would probably have to pay more interest to get a fund guy in, right? This is the dynamics with which he's coming out to the market. Now while he's coming, the guy who is getting funded for a project, the NBFCs or the LICs and the banks are there, let's assume, and the private equity there. Let's assume these are the four categories, prime categories, and infrastructure fund. Where do you think the infrastructure fund, banks, and LIC will not get into land acquisition, right? Will not go on get riskier or be part of a business conceptualization, right? Because it's public money again. So who will be part of business conceptualization or the project conceptualization is the venture capitalist or the HNIs. So those funds is called the private equities or the other players. I won't even call NBFCs. NBFCs at least define their objective of their business, and still they are governed by certain aspects.
Let's call them some kind of infrastructure funds. They are different variations of infrastructure.
They may not come at a conceptualization stage, is what I'm saying. Even NBFCs may not. So who would probably come is the private equity. That's where the private equity word itself exists.
Okay.
Right? So when the private equity comes at a conceptualization stage, they become a co-founder or a co-partner.
True.
Which means there is a clear-cut share of aspects. So this private equity can become as fund, or there could be a partnership by the builder who is conceptualizing towards a land bank, landowner,
Yes.
right? So
Yeah.
I am a developer, I am conceptualizing a project or a concept. Now I need one side land and another side finance as a resource to even make this idea or a concept reality.
True.
Right? So what I do I go to a finance, I raise fund for project construction plus land from a private equity, and then go acquire land and then do it. Then I have to be mindful of the fact the project has 30% margin. Out of this 30%, how much am I give it back to these?
Typical startup considerations. Do I trade more debt or do I trade more equity? Right. So there are typically, if you go for equity, then your stakeholdership goes down, but then you're not sinking on interest payments from day one, right? And another fun fact here is entities like, I don't know, IDFC for sure, but definitely HDFC, ICICI, SBI have they have like 3-4 divisions with vastly varying risk appetite, right? They have sections of the books with like very different risk appetite. There is like the whole super conservative end of the spectrum, which is lending home loans for like super safe salaried people, to like okay builder financing, to like conceptualized the funding where they could afford to lose a little bit of money, but they want that disproportionate returns. So some entities like HDFC, ICICI, IDFC, and all of them, they SBI, they have 3-4 divisions across the spectrum with varying levels of interest, risk appetite, and return expectation. Am I right?
Understood. No, you're absolutely right. Um, See, again, I'm trying to paint a canvas. Then I understand what you are trying to
Yeah.
put it. I'm trying to even make or speak about the dynamics with which it works. Probably lot more players, lot more permutation combination player exists,
Yeah.
which
Yeah. Yeah. True. True.
none
True.
of
True.
us actually see as a, or probably we've not coined them with a name. But in India, at least, there are various players like just about flipping, right? What
Yeah.
you use in the West, there are various concepts at a B2B level, at project conceptualization level,
Yeah.
where people have, I mean, the famous word in India is Jugaad, right?
Yes.
They
Yes.
have done the Jugaad models enough to. Jugaad models are basically eventually have been regulated and gone on to become a better fund, line of investment or line of capitalized product.
Apparently, these are the crux of the frugality mindset. Jugad is basically ensuring
Yes.
win out of limited resources, and yeah,
Frugality
like you
plus
said.
creativity, right? Creativity in
Exactly.
kind of creative business models and stuff. So essentially, Arun, what you're saying in this is there is a wide spectrum. Like if you draw a graph across time and return, you start with more risk, right? You're literally paperware, as you call it, right? With combination of equity and debt. Then it goes to slightly moderate risk, which is more like the hey, I'm already working on the project, but it is pre-development to kind of launch and get that arbitrage of return, which is probably 15, 20, 30%, to like very safe haven, which is mostly the apex bank rate plus 2%, which is what 2-3%, which is what your home loan fetches you for the bank. So this is kind of the spectrum. Start with probably pure equity or equity plus debt, to like high yield debt when you are kind of flipping over the project from under construction to construction, to like definitely constructed output, which is more like your home loan.
Absolutely right. So basically, if you see, there are people. Just to add to what you said, there are two things. One is the models which are government regulated, who are a finance business model, right? Who are into financing or banking, things who are regulated by, say, the Apex Bank, which you called as RBI. Their risk-taking capacity is completely regulated, right? It is spelled out by words, by actions, by scope of expansion, by scope of deploying and collecting money. Everything is on the other side. There is a scope called private equity where it is relative, or probably a scope is like completely free, right? Which is like 2-3 people pool funds and then they go on to take those risks. So where will they take risks is like how you said, like a startup where I know this founder, I know this guy, probably I take a heavy stake on the project, and then I co-work with the developer, right? So typically they go sit as a board member and things like that. So that's the range with which, as this is happening, the developer who's actually conceptualizing also becomes smart, right? I mean, he is a separate guy who is trying to make a good right margin for the travel he's going to do as an individual or as a company through the years, right? So these dynamics and these perspectives is where things in, and as all these things are happening, there is always a retail investor who would like to be part in every stage, right? Who wants to be the smart guy, who wants to go the one layer up and things like that, right? So he would do certain smart things, and that those sort of jugaad models have also come up, right? Similar ways, the develop from developer side, marketing and sales angle wise, how do we get the least capital, instead of me going towards a bank, taking loan, and then going, pushing the entire risk leverage to consumer. Why don't I go directly on project conceptualization to the consumer, take the money, and start leveraging? Is what happened in the previous year, era, where few developers who didn't know how to manage finance and actually, started seeing a lot of cash in the hand, um, started, buying next land, next projects, and things like that. That's where the risk completely fell on the market, and the market, there are enough Gurgaon stories which we know, where even, Dhoni, the picture boy for a developer, where all those things we saw as a kid.
There are
Right? So
multiple state level and national level biggies where the odd project has gone very sour, and there are some builders who are pretty famous or still who've been in operation for 20 odd years, but they are pretty notorious for every other project kind of going sour. Right? I mean, they carry that reputation, but somehow they're still surviving. So all of these cases are there. So two areas I definitely want to focus. I think today we might not have time to go deep. I think we have laid out a very very good kind of landscape, because we have started literally from the whole spectrum, from financing to this. I think we have given enough kind of primer. But two specific topics I want to dive deeper is, one is, we all know for a fact that what is typically very high level, the intervals at which builder goes and raises funding, very standard. Like, it may vary, but then, okay, I show the concept and I get funding, or I show the diagram and then I get the funding. I raise this level of stilt and I raise funding. These kind of things we want to go a little deeper. The second level of thing which I want to go, which is very interesting for our viewers, especially for buyers, is the whole nuances around buyer financing, right? Typically, if it's a 1.5 crore home, and if it's an under construction project, they're obviously not going to give 1.5 crore on day one, right? There is going to be a milestone based payment. So what are these milestones structured around? And then this whole 80/20 scheme, or this no down scheme, there are a lot of creative marketing you do around financing also, right? So give 100 rupees and get possession, and all of those kind of gimmicks. So I want to focus on both of these. Like, you can prioritize. If the buyer side is more fascinating to you, you can pick that. Let's see how far we go. Maybe we have to continue.
Actually, I see this. I mean, we'll subsequently, in subsequent episodes only, we're going to pick these topics and dive deep. Just as a immediate comment, what I would like to say is that both what you said invariably have the builder as an objective. Right? The deciding factor of that remains the builder, because in terms of B2C, the payment schedule determines what you spoke about, right? Which means all what you said as schemes are all, you simply put, or as a headline, if you say it is a payment schedule for a project, right? So the schedule could be 80/20, or 20 upfront, 80 afterwards, or 80 today, next to 20. So basically, if you see, it is also the other side of the same coin for the developer, where how does he get the fund and optimize the money inflow, right? Today's money is X cost, tomorrow's money is Y cost. So then the builder takes certain calculation, and they do these perspectives, and marketers like us tend to put a story around it so that the consumer understand it clean, simple,
Exactly. Exactly.
right? So that's all it is. Otherwise,
Especially when there is a story, I want to know whether it's truly a gimmick or there is value to it. If it is value to it, then somebody has to take burden. In finance, there is no free lunch ever. Like, especially in finance, you can even do marketing for free and get paid later. But money, obviously, somebody has to pay for the cost of the money, right? So if there is a gimmick, is it
no,
truly a gimmick, or who's kind of bearing the burden?
I don't see nothing as gimmicks, right? It is
Okay.
based who takes that leverage, who, at what risks, right? Against
Okay.
what risks? Those are the things, right? So ultimately, everything is going to be paid by the consumer. If the
Okay.
project is conceptualized with, say, let's assume X funding plus X interest, X land cost, then inevitably the project is going to be, who is going to consume it? The ultimate buyer, whenever it could be, right?
Yeah. Yeah.
So consumer is the ultimate. That's global economy,
Yep.
right? So
Yes.
consumption is the ultimate that's why we call them consumer, right? So
Correct.
the consumer is going to be the ultimate person, right? And that's
Yes.
where I said the bank's primary objective is to go towards consumer and
Correct.
take a long-term approach. That's bank's approach, right?
Yes.
Banks make huge money there, not in project financing, to be frank.
True.
They take huge risk by funding the project.
True.
That's where the objective of bank is different from a private equity. Private equity makes good money in the project funding because he is basically a consumer for the bank, but not for the project.
True. 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 True.
That dynamics is there. So this is like a large economy or the money travel or money spin or the
True.
economics of the real estate or how this primary market is consumed is what basically we are talking about. And what we need to understand is the director of this entire scheme of things is the developer.
Okay.
Depends on, right? Everybody wants him to execute. Why am I calling director? Is the managing director of this entire economics. The
Sure.
bank depends on that founder to do it well. The consumer depends on that director to do well. The investor depends on that guys to do well. So everybody is trying to also be dependent on that person. So how much value that guy could leverage from the market for himself is the credibility of the developer,
Super.
right? So that credibility of the developer is what uh, the balance a private equity bank and the consumer takes vis-a-vis a real simple gimmicks, the word you used, right?
Definitely.
So
Definitely.
it's not just the advertisement which people go by, it's also the credibility. The credibility is the track record. The track record would be as simple as one project execution, or you come with some other business success. Now you start a project, so you have a track record of managing money, because this is the highest consumer good, and you're going to pool, say, at least 100 consumers money as a project, right? Which means it's very, very high on cash, but the almost out of that 70-80% is cost.
Correct.
Straight away, if even, but that 70-80% is not going to get spent overnight. It has to be spent over the project duration, which
Yes.
means if for a second, if the founder or the managing director go against his morality or right sense and think that, okay, hey, this money is there today, probably it can be used only 6 months next. I get cash today, right?
Okay.
But I have to spend it over a period of 6 months. The money is sitting with me. Then if he starts becoming shrewd and starts seeing that as real wealth instead of cost, right? That's where problem comes. So what I again, the entire scheme, I always say that developer or the director is the ultimate guy who could basically blend and make this as a success. No other individual could, a private equity guy, even if he's spending 80% on the market, on the project, he is not going to take it to the end line, right? The banker, if he funds 60% of the construction project, he's not going to take to the end line. The consumer who's going to ultimately pay 100% of the project is not going to take it to the end line, right? So that's where, yeah.
No, fantastic. I think we started very slow, but then lot of middle overs and slog overs hitting. So we've given some fantastic points. What I would like to probably take away for the next episode, I think we have laid down the actors, we have laid down their incentive structures, their motivations, and the importance of capital and the basics, which you cannot fool around with capital, whatever gimmicks you put around it. For the next episode, the same financing, I want to look at it with a slightly different lens, right? When you started giving your intros over the 2-3 years that I know of you, you don't stop just with sales and marketing. In your own experience, both with the builder side and as a broker, channel partner, digital broker, you emphasize a lot on collections, because sales and marketing doesn't end with the word collections. When I used to initially meet you, I'm like, what is there in collection? He sold it. The buyer is kind of signed up to a loan and done. but you have laid a lot of emphasis whenever we've met on collections. Sales and marketing doesn't end with sales and marketing. Collections is really where the actual sale closes, right? And obviously, bank is hugely involved in collection because most cases, but somebody's not going to take 1 crore 50, or 2 crores out of their pocket and throw at you, right? Typically, collections involve you as a sales slash collection person working for the builder, plus the bank on the other side kind of helping in the financing, and the buyer kind of going through the journey, right? It could be multi stages or whatever. So let's look at this whole financing and buyer B2C from a collections aspect. What is the collections life cycle? What is involved from you as a salesperson and the bank and the buyer? Okay, is that a good idea?
Superb. I'm already thinking of certain punchlines, but let me reserve it for the next episode.
Because I think for even for realtors or brokers coming new into this is a very important aspect. They should be very clear that just doing fancy marketing, whether it's digital or physical or hoardings or radio, it doesn't end there, right? Obviously, that's fantastic if you're a master in generating interest and buyers, nothing like it. But then the devil is in the details. So collections is a very vital part, right? How the money hits the bank is very
That is
important.
where just to give add comment to that marketing angle. That is where it's very important to understand what is your minimum viable. I underline and repeat, minimum viable sale number which you would like to achieve at every
Yeah.
point of product cycle, which is very, very important. Without knowing that, if people go on to splash ads and go towards leads quantum or database, they're going to fall flat.
Okay.
Because it is, as I said, this product, the director or the builder, at every point of time, he's answerable to a board member who's going to have a government, who's going to have a bank, going to have consumers and a private equity, right? For every action of his, he's going to go report to that board members.
So
Just think as a startup where all of these guys are funded.
yeah.
You
With
know how startup.
wildly different risk appetites, wildly different time horizons, wildly different regulatory seriousness. So
Absolutely. So that's why it is very complex. So that's why you see only, I mean, developers tend to also get the best out of for his execution, also get all the blames for any shortfalls in the execution,
true,
right?
true, true.
So even if and we easily say a 6 months delay, right, or a 1 year delay, but 6 and 1 year is like a fantastic job,
Okay.
right? Uh, it's like an amazing job if somebody is able to give you a product to the end line with a 6 months delay or a 1 year delay, right? But unfortunately, but just imagine, because delay is basically counterproductive for the builder also.
True. Yeah, yes.
So
Yeah.
in
No,
spite
definitely.
in spite of it, if somebody is actually delaying, then I mean, okay, I'll leave it there. That's
Once there is a collateralized asset, the bank is the only person who benefits from delays, right? That is why once there is a collateralized lending, whether to the builder or to the end customer, bank locks a rate from the Apex bank or the money system, and then they kind of lock a period. Yeah,
no, Badri. See, what you're saying is only for a ready to move in, which means
true.
after the product is completed.
Yeah,
See, the major portion or the problem is in from the project conceptualization to the end line of first consumer owning it. This
true.
is what a different game is. The secondary market is like completely different, right?
Yeah. No, yeah,
In,
the semi-ready state, right? I mean, it's not a usable asset, but at the same time, it's not worthless. So the
you
delay is
tell me
very
how
painful.
many you tell me how many players or financial institutions are there in secondary, except banks?
Uh, no idea. I mean, you can. Okay.
None.
Okay.
None.
Okay.
Nobody would fund for secondary just like that.
Okay.
They might mortgage the property for a business. That is different, because the business loan for which a surety is taken, that is different. But I'm saying for a secondary or a retail level or ready to move in post that, only banks can play, because he's the one who can play a long term game, which is
Yeah.
25 and things like that. Nobody else. So the prime factor is project conceptualization to the handing over date. This is where, I mean, I'm actually revealing the secret for the investors, is this is the time where people make money.
Okay. 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 So
Rest are all is like, will simply after the dead, handing over date, the appreciation plus the rent will inevitably match your FD rates or
true, true. This is true.
inflation. It will only
This,
compensate the inflation
this is
plus
true.
FD rate, right?
This is true. This is
That's
true.
the maximum it will get. So if people who have really succeeded, and that's why you see developers become richer than an investor,
Okay. Okay.
because it's always in between, right?
That
He does
window.
not.
That window. Yeah, that is a much higher than FD. It is because it is not equity, it is debt, but it is still very higher than the FD type of interest. That is why that there is wealth to be made there, right? So whereas most other things, like as you said, the ready to move in building apartments will typically, finally, economics ensures that it kind of tends towards the FD rates. But then when it is semi ready, and that is where the transformation happens, that is where the magic happens, that is where the higher debt interest rates are. Yeah, I think we've gone quite over the time, but then it was a very interesting topic, so we will focus more on the collections part of it in the next episode, right? I mean, so yeah, Balaji, over to you.
Builder business model is like, we cannot ignore that person. See, that's why I bring him. Just, it's not that he's my customer and I work with him, I bring him. It's basically this industry without that pivotal guy, right? You can't see a banker, you can't see a broker, you can't see a buyer.
True.
So that's the play. He's actually the centerpiece.
Yeah.
Well, I had few points to make over here, and turns out Arun ensured those points were addressed as well. So thanks for that. And uh, and on that note, I'd like to conclude today's episode, and we have some more sharp focused discussions coming forward in the upcoming ones. Once again, thank you, Badri. Thank you, Arun, and thank you for ensuring that things are more precise than even I could articulate in a way that you did.
Definitely.
We'll take things forward in the upcoming ones. Yeah.
Thank you, Balaji.
Thank you.
Thank you.
Cheers.
Bye.
Bye.